Hello, everyone, and welcome to today's session on the Scale Up series entitled The 2021 Road to Economic Recovery. My guest today is Charlie York. Charlie, you want to say hello?
Yeah, hello, everybody. I'm really looking forward to today's discussion.
I'm going to ask Charlie to introduce himself more thoroughly in just a minute, but a couple of notes before we get started. I want to first acknowledge the GovConnects sponsors, which, Taylor, if you'll pull up that slide here, without their, it'll come up here in just a second, but without their financial support, this series would not be possible. So we thank them very much for their generous support. There we go. Tower Federal Credit, Uninet, Aronson, and the others that have been very generous throughout this year, and we hope to have them as sponsors for the 2021 series as well. So a few instructions before we get started. We will not have a PowerPoint presentation, but we will be sending a handout to the participants afterwards. If we were in person, we would normally ask you for your business card, but in lieu of that, the Chamber is going to share with us your contact information. However, we respect your privacy, so we're going to give you an opportunity to opt out. So Taylor, if you put that little poll up there, if you do not want your contact information to be shared with the presenters, then please opt out here. Otherwise, you can expect an email from us, and we will have a checklist and a couple of other things related to this topic that we're going to send you afterwards. We ask that you ask questions as we go along, but we're going to hold those to the end. So use the Q&A feature to ask your questions, and as we come to a conclusion, we'll pull those up and answer them. So given that we've just had an election, elections have consequences, of course, we're going to be talking about the impact of the election as it relates to federal contractors. So to help me sort out these issues is Charlie York, Senior Director and Team Leader at BNY Mellon Wealth Management. Charlie, tell the audience a little bit more about you and what you do at BNY Mellon.
No, thank you very much, Shirley. Again, I'm delighted to be here with you all today. Just a quick housekeeping note, I'll be sharing a lot of views and opinions. Those are my own and not those of BNY Mellon Wealth Management, but I think you'll hopefully find it informative. So just by way of background, I grew up in the Washington, D.C. area. I studied physics at Cornell University in New York on a Navy ROTC scholarship, and then spent 7 years on active duty as a naval aviator. Later, I was a reservist working with the Naval Air Systems Command. I retired as a reservist at Commander 05 level. I have had the great honor of serving on the board of USO of Metro Washington, Baltimore. So got to know a number of government contracting organizations in the area. In my business career, I've worked for over 25 years after business school in the investment management field. Currently, I serve as team leader and senior wealth manager with BNY Mellon. In this role, I lead a team of 7 investment and fiduciary professionals with a focus on delivering leading wealth management advice and service excellence to the firm's clients in the greater Washington, D.C. metro area. I personally work with clients to address the investment and wealth management needs. This includes some of the largest and most complex of our client relationships.
Thank you, Charlie, and welcome. My name is Shirley Collier, and I'm the president and founder of Scale to Market. We help government contractors think, plan, and grow in the complex federal marketplace by developing and executing customized, data-driven business development playbooks. Okay, Charlie, so to get started, let's talk about 2020 and put it in context. It's been a difficult year for many industries, but the government has not reduced its spending. What are your observations of federal spending in 2020 and the market's performance?
Wow, what a year it's been. Like natural disasters, Katrina, Superstorm Sandy, the novel coronavirus came onto the scene early in 2020. This led to efforts by health officials and policymakers to flatten the curve and measures to restrict economic activity in what became known as the Great Shutdown of 2020. We all know what happened to the US economy. There was contraction in gross domestic product in the second quarter of 31%. This was followed by massive policy response that was designed to build a bridge to recovery, including several fiscal stimulus measures, including the $2 trillion CARES Act. By way of context, that represents about 10% of GDP. The Federal Reserve, importantly, swiftly cut interest rates to zero and literally threw in the kitchen sink of policy measures, including asset purchases and the lessons learned from the great financial crisis to help stabilize financial markets. Your question was about federal spending in 2020. Government spending related to the pandemic and the government's response included the CARES Act. This resulted in outlays that were significantly higher than in previous year. In looking at CBO statistics, the Congressional Budget Office estimates that outlays in fiscal 2020 were $6.55 trillion, or about $2.1 trillion, 47% higher than they were in the previous period in 2019. This resulted in a federal budget deficit of about $3.1 trillion in fiscal 2020. This deficit, estimated at about 15% of GDP, was the largest since 1945 and was more than triple the shortfall recorded in fiscal 2019. So what drove this deficit? The CBO estimates that revenues were about 1% lower, but outlays were 47% higher in 2020 than they were in 2019. I think when we look at it, revenue collections and outlays in fiscal 2020 can be divided into two periods. First, before the start of the economic disruption caused by the pandemic, and that is then also after the start. So for the first 6 months, the 2020 deficit was about 8% larger than the 2019 shortfall, with receipts running 6% above last year, but spending up 149 billion, or 7% higher than they were in the same period of 2019. That increase reflects greater spending on the largest mandatory programs, so think Social Security, Medicare, Medicaid, but also on the Department of Defense and Department of Veterans Affairs, which saw higher costs, and also we saw greater net interest on the public debt. However, the second 6 months, from April through September, saw the deficit grow 8 times the deficit of the prior year. Receipts from April through September were 7% below, given the contraction, but outlays from April through September were nearly twice the amount in 2019. They rose by $2 trillion. Large increases clearly were linked to the pandemic and the federal government's response. And that, I think, was the story on federal spending. But turning to the capital markets, we've really seen 3 periods in 2020. First, the advances of the early part of the year, followed by what we call a waterfall decline. So think a precipitous drop starting in February on the 19th, to be precise, with the S&P dropping about a third before it bottomed on March 23rd. And then finally, the third period started in late March, when stock markets anticipated, as they always do, what occurred starting at the end of second quarter, and they rose 50% in that period from end of March through the end of September. In the fourth quarter, started October, we've just seen a lot of volatility related to the election, but a general uptrend in stocks. And most recently, we've seen a rally as we've had less uncertainty about the election, and also some positive news about on the vaccine front.
So it's been an historic year, to say the least. Charlie, I know you don't have a crystal ball, but what does history tell us, given that we've just had an election? What does history tell us about market performance under various scenarios of partisan control?
Sure, yeah, I wish we had a crystal ball, but in the absence of that, looking at history is great. And so when we look at periods where presidents you know, have, I mean, it's important to note that presidents and their policies certainly influence the direction of the economy, but it's critical for the passage of legislation to look at the makeup of Congress. So looking back over the last 86 years from 1933 through 2019, it's fair to say markets have tended to like split governments. The best market returns have come when a president has worked with a divided Congress. Historically, that's averaged about 13.5% annually. In contrast, the worst average returns have occurred when we've had a unified Congress. And those have come historically with a Republican president up about 4.9%, followed by a government involving a Democratic president of about 9%. But with all of that said, you know, Mark Twain once observed, history doesn't always repeat itself, but it often rhymes. So it's worth noting, you know, when one party controls the White House and Congress, the party that is not in power often suffers defeat at the next midterm elections.
So given the recent election results, or what we think the election results are going to be, what are the likely policy priorities and market reactions?
Sure. So we look at the world in terms of scenarios, and our base case is divided government. So we look at, you know, what the people have said, the people have spoken, and it appears that American voters want to keep a balance of power in Washington. You know, although the votes have yet to be certified, and there's certainly going to be some legal battles here ahead, it looks like former Vice President Biden has won the U.S. presidential election of 2020 and will become the 46th president of the United States on January 20th, 2021. You know, there are certainly some hurdles to overcome, but it seems that President Trump's chances of retaining the White House are looking increasingly remote. You know, there's a good article in the Wall Street Journal this morning about that, which talks about some speculation about the strategy involved, but it is, I think, a remote possibility. On the congressional front, it's most likely, but not guaranteed, important to note, not guaranteed that the Republicans will control the Senate in the next legislative session. Democrats have clung on to control of the House, but with a diminished majority. So we're all going to be watching, and if you live in Georgia, going to be hearing a lot about some runoff elections in early January. There is a possibility Democrats could win both of them on January 5th. If that were to happen, we would have then a 50-50 Senate, and Vice President-elect Kamala Harris would break the tie. Not exactly a blue wave, but more like a blue mist, perhaps, but still, quote unquote, unified government that could, in that event, result in a significant policy shift. So let me outline what our expectations are for really the two scenarios we see involving a Biden victory. As mentioned, the most likely case is divided government, with Biden becoming president with a GOP Senate. What this means is the policy focus would be on likely job creation through infrastructure spending, fighting the pandemic, more regulation, and expanded healthcare coverage. Biden's tax proposals to raise taxes on the highest wage earners and corporations will likely be restrained, especially as the economy is still recovering. A complete reversal of the 2017 Tax Cut and Jobs Act tax cuts is probably going to need to wait until 2020 for potential change of the Senate elections. But at this point, we think that this divided government is something of a Goldilocks scenario for the stock market, and it's likely to be bullish over the medium term. So we saw immediately after the election a rally on the stock market, reflecting the really reduced likelihood of sweeping tax and regulatory changes, and also an unwinding of some of the, quote, blue wave positions that had been taken by market participants ahead of the election. So it's often been said investors tend to consider gridlock good. That is the legislative inaction that often comes with a divided government, as well as the benefits of more favorable international trade policies that are likely under Biden. On the fixed income side, we do think interest rates are likely to remain range bound, and therefore, along with lower inflation expectation, the bond market yield curve is likely to stay relatively unchanged. The dollar is likely to weaken. Turning to the second scenario, if the Georgia Senate races in early January both go to the Democratic challengers, this will cause the GOP to lose the Senate, and then we would have the scenario of unified government under a Biden presidency and Democratic control of House and Senate. This scenario could potentially lead to more fiscal spending and potentially sweeping tax changes, with the Biden administration having the ability to pass its economic package really through the Senate on a reconciliation process, which we would expect to be under mostly party line votes. And then taxes might go up as a result. This is, we think a lower probability, but investors still should, in that scenario, worry that tax increases would lower after-tax corporate profits and economic activity. So if you think about that time frame in early January, if we were to see both seats go to the Democratic challengers, we would be expecting a knee-jerk market sell-off. However, we think that the markets have a lot of other tailwinds behind them, so that sell-off might be short-lived. But meanwhile, we do think the economic recovery remains a top priority. So there's good likelihood that the tax policies would both take longer to implement and might get watered down. So in this scenario, we think that interest rates and inflation could rise due to the greater amount of fiscal stimulus. And again, the dollar would weaken.
Now, Charlie, I always thought that under a Democratic administration, there was more spending, and under Republican administration, there was less spending. But that doesn't seem to hold true. Under the Trump administration, government spending increased substantially, even before the pandemic. So what can we expect, those of us who sell to the federal government, what do you see continuing in terms of spending?
Sure. Again, assuming the divided government scenario with a GOP Senate majority, we think that the multi-trillion-dollar fiscal stimulus plan and most of the Biden economic agenda is likely off of the table. But with that said, there are many opportunities for compromise. There are some areas of bipartisan agreement, and common ground is likely to be found on infrastructure in particular, with Biden expected to propose infrastructure spending as a means of job creation. Biden is renowned for his willingness to compromise, and he has a long-standing relationship with Republican Senate Majority Leader Mitch McConnell. So, with 13 million people set to lose unemployment benefits at the end of 2020, Senator McConnell has said that getting a new stimulus deal is his top priority when Congress returns for its winter session. However, with the two parties pretty far apart, it seems that stimulus aid in the $1.5 to $2 trillion range might still take several months and multiple bills to achieve. And so looking ahead to President Biden's term, depending on what sort of stimulus bill is passed in the lame duck session, we expect that Biden will continue to seek additional stimulus to support the economy. But again, this is unlikely to be along the lines of what was passed by the House, the HEROES Act 2.0 proposal. So to summarize, even if a $1.5 trillion package is quite large, with the likelihood of a vaccine close to approval in the coming months, it's probably in that range, in the 1 to 1.5 range is what we would expect. It's important to note the debt ceiling will need to be raised in July, on July 31st of 2021. So we expect, and analysts tell us to expect the Republicans to likely move into austerity mode in anticipation of that. Turning to infrastructure, just briefly, Biden is expected to be willing to compromise with Republicans, and analysts expect he would potentially get some modest incentives for green energy initiatives like solar, wind, electric vehicles. There's also bipartisan support for onshoring to reduce our dependence on China and to try to shift production back to the United States. Finally, there's some scope for potential bipartisan agreement on some modest drug price controls.
That's interesting. Charlie, what are the potential tax law changes that we might see based upon Biden's tax proposals that he talked about during the campaign?
Yes, for sure. He campaigned on proposals that were really quite progressive and would introduce a fundamental shift in U.S. tax policy. And as business owners, these shifts could have a significant impact on your business and your wealth if enacted. However, it should be noted the last time we saw bipartisan cooperation on a major tax bill was 34 years ago in 1986 with the Tax
Mm.
Reform Act of that year. Since then, there have been 4 significant pieces of tax legislation under Clinton, Bush 43, Obama, and Trump. And in each case, one party had full control of the government. So we don't expect to see major tax changes coming unless one party controls both Congress and the presidency. Turning to Biden's tax platforms, it has a few key elements. First, on the corporate front, there are 3 main proposals. First, an increase in the corporate tax rate from 21 to 28%. This would be halfway back to the 35% that was in effect prior to the Tax Cut and Jobs Act. The other 2 include a new 15% minimum tax on corporate book income and an increase in tax on profits earned by foreign subsidiaries. Turning to individual taxes, Biden's tax proposals would impact both income and estate taxes. Starting with income taxes, his plan would reinstate the top ordinary income tax rate of 39.6% for taxpayers earning more than $400,000. A more significant tax change would apply to investment income earned by high-end earners, particularly those with income over $1 million. The preferential rate on long-term capital gains and qualified dividends would be eliminated, and this income would be taxed as ordinary income. This change would effectively increase the tax rate on such income from its current level of about 23.8% to 43.4%. That, of course, includes the 3.8% on net investment income under the Affordable Care Act. Biden's plan would also roll back the Tax Cut Jobs Act changes for high income taxpayers. It would seek to eliminate or at least limit the value of itemized deductions, capping those at 28% versus the 39.6 tax rate. And so this limitation would have a significant impact and be a haircut for high-end income earners. It's likely that Democratic control of the Senate would also bring back full deductibility of state and local taxes, so-called SALT deductions, whose elimination has impacted taxpayers in states like Maryland, New York, Massachusetts, California, New Jersey, and so forth. Turning to estate taxes, estate and gift taxes are an area where some of the proposed changes are very significant. Currently, the federal estate and gift tax exclusion allows individuals to give away $11.5 million of assets or $23.2 million for a married couple over their lifetime or at death. Amounts above that are subject to a 40% tax rate. This exclusion level could potentially decrease to as low as $3.5 million per individual with a 45% tax rate above that. So for a married couple, going from 23.2 to $7 million. In addition, Biden has proposed the elimination of the so-called step up in basis, which adjusts the cost basis of property transferred at death to its fair market value for heirs. This proposed change would cause heirs to face a very significant income tax liability on the sale of any inherited low cost basis assets.
So, Charlie, if that were to happen, what advice do you have for business owners who might be considering selling their businesses?
Well, let me start by saying, we advocate avoiding any emotionally driven decisions, either in investment or planning matters based upon the election. We realize it was a very difficult election, and people have strong feelings, but be careful to make sure you consult with all your advisors in making decisions of this importance. But in response to your question, in our view, the most time-sensitive planning strategies are those that involve mitigating the adverse tax consequences of a potential blue wave. That is what might happen if both Georgia seats were won by Democrats. So to offer a few planning ideas, things we're talking to our clients about include: first, making gifts outright or in trust before the end of 2020 to take advantage of these higher lifetime exemptions. In effect, use it or lose it. Second, many clients are creating what are called spousal lifetime access trusts, known by the acronym SLAT or SLATs, to provide some flexibility. But it's important to note, you really have to get your documents in order and drafted ASAP, and then have those slats funded by the end of the year. If you are contemplating the sale of your business and you're close to terms on that and making that final decision, we would advocate selling the business in 2020 if possible, to take advantage of what is known about the tax legislation. Turning to your investment portfolio, selling low cost basis investments today, locking in today's more favorable long-term capital gain rates if it makes sense. And then also, to mitigate the risk of the step-up basis being eliminated in 2020, consider funding any types of charitable gifts, donor advised funds, or foundations, at that point in 2020 with any low basis assets that you have. And then lastly, in this low interest rate environment, we should remember that there are a number of planning strategies that benefit from low interest rates, and we can take advantage of those. For example, intra-family loans, grantor retained annuity trusts, and charitable lead trusts, intentionally defective grantor trusts, and so forth. There's a bunch of those, but encourage you to talk to your tax and planning advisors.
Now, we have had some significant capital gains increases, tax increases in the past. What has been the historical impact?
Sure. Yeah, it's always good to look to history for lessons. So recall, Biden's proposal would to eliminate the current preferential rate on long-term capital gains and dividends would, as I mentioned earlier, mean a top rate of 43.4%, which would be the highest rate since 1978. I teach finance to undergrads at a regional university, and I tell them that finance theory teaches us that raising the capital gain rate lowers the after-tax return on stocks, all else being equal, making stocks less attractive. And so when we look back in history, the last time we saw such a large tax hike occurred under President Johnson in the late 1960s, early 1970s, when capital gain taxes were raised from 25% in 1968 to 49% in 1976. That resulted in a 10-year stock market return of a negative 4.7%. So, when President Jimmy Carter took office after this 10 years of dismal stock returns and a weak economy, he was forced to cut the capital gains tax, and he cut it to 28%. Since 1979, capital gains tax rates have never been above 30%, and we've seen S&P 500 returns averaging about 0.8% per month in the 40 years since then. So, given the possibility of the Democratic Senate following the Georgia runoffs, we do anticipate that in a number of companies that have the flexibility may pay some type of a special dividend prior to year end 2020. This is exactly what happened in late 2012 in advance of what was called then the fiscal cliff. So stay tuned.
So Charlie, you mentioned this a little bit earlier, but I want to explore it, and that is the risk reward of waiting until next year to sell a GovCon business. What are your thoughts on that?
Sure. As mentioned earlier, if you're contemplating the sale of your business and all else being equal, it'd be preferable to sell prior to year end to lock in the current tax treatment and mitigate the risk of higher taxes next year. Divided government with a GOP Senate is not a guarantee. There is a narrow path for the Democrats to take the Senate if they win both the Georgia runoffs. That scenario, while it's not our base case, could lead to the implementation of the Biden tax proposals I outlined earlier, with Vice President Kamala Harris casting the deciding vote to pass tax increases through the reconciliation process. I'm sure many are familiar, but that is a process that can be used to pass legislation in the Senate with a simple majority, provided the provisions of the bill have direct fiscal implications, such as, of course, changes to taxes.
Now, you've talked about different sectors of the economy, but I want to delve into those a little bit more in terms of the potential implications for economic activity in each one of these sectors, starting with aerospace and defense.
Sure. So starting with aerospace and defense, first its statement of that everyone is aware that there really is an environment of heightened geopolitical tensions. Those types of heightened tensions tend to be supportive of defense budgets, and the world remains as tense as ever, and geopolitical concerns are likely to fuel spending. Existing military investment is unlikely to be reduced when it stimulates the economy and helps to boost industrial jobs, which will be a focus in job creation. Additionally, we believe that investments in research and development projects could lead to breakthroughs in artificial intelligence, robotics, cybersecurity, facial recognition, or technologies that might have commercial potential. To quote a industry leader, Northrop Grumman CEO Kathy Warden recently said, we expect to see continued strong bipartisan support for national security in the future, as indicated by the $740 billion targeted for fiscal 2021 appropriations. While we plan for various budget scenarios, defense spending is largely threat-driven. Emerging threats are intensifying, and we believe both political parties are committed to effectively countering these threats. So with that said, deficits matter, and the federal budget deficit is likely to be in excess of $3 trillion this year. And as such, the defense budget will be under scrutiny. The debt ceiling needs to be raised by July 31st of next year. So we anticipate negotiations could put some pressure on defense spending.
Now, Charlie, there are many tech-driven government contractors in our region. So what do you anticipate will be the impact on technology spending? You mentioned a little bit about defense, but what about in the civilian sector?
Sure. So Biden has announced a quote, Buy American plan that we believe would be positive for the broad technology sector. He expanded access to broadband internet, increased investment in 5G and artificial intelligence. And we think this could benefit network equipment suppliers and cell phone operators and REITs. The expectations are that technology companies will face increased regulation. There is bipartisan support on the Hill for greater oversight of the digital economy. Biden has not outright called for breaking up big tech, but expectations are that Biden would have a tougher stance than Trump on antitrust and on big tech in general. For example, Biden favors a restoration of net neutrality rules that limit the throttling of content and on internet networks, and also promotes greater data privacy regulation along the lines of what is in the European Union, the GDPR. Finally, analysts expect that the Biden administration would maintain a hard line towards China on matters related to trade, cybersecurity, and technology transfer, although likely with a softer tone and more multilateral international cooperation.
And of course, Charlie, we are all impacted by healthcare policy and spending. Where do you see that going?
Sure. Democrats campaigned on lowering drug costs and creating a quote public option to compete with managed care companies. This would be negative for healthcare stocks. So the current scenario of divided government seems to, put that risk into somewhat of context. Because while the public option is a big risk to healthcare, under Democratic control, even under Democratic control, passing it is far from given. Making large-scale changes to healthcare in the midst of a pandemic would be very difficult, especially when we look at Vice President Biden's focus on containing the coronavirus and protecting those who've lost healthcare coverage since the pandemic began. If we do have unified Democratic government, we could see an increase in NIH spending to support healthcare research. That would certainly be positive for life care, diagnostic and testing equipment. But it seems to analysts and to us that the top health priority of a Biden administration is likely to be to strengthen and expand access to the Affordable Care Act, commonly known as Obamacare, by expanding subsidies to increase participation, and do this rather than take on drug companies. So an expansion of Medicaid would really benefit healthcare providers, so managed care and health insurers, hospitals. But looking at some of Vice President Biden's other proposals, he favors, Medicare drug price negotiation, more drug imports, increased supply of generics, international reference pricing, reform of prescription drug advertising, and price caps, limiting price increases to inflation for branded drugs. But really, to summarize, with a Biden win and a split Congress, it seems reforms to the healthcare system are more likely to be modest and in scope, particularly given the ongoing COVID-19 pandemic and the high levels of unemployment. And in that environment, we've seen a lot of support for healthcare stocks, and we think that will continue. We also think that Biden's win, is likely to preserve the Affordable Care Act, which of course the Republicans would like to meaningfully change. But the Supreme Court is likely to weigh in on this and will be ruling on the legality of the ACA in June of 2019. That could be a wild card.
June of 2021, you mean?
Sorry, 2021.
Yeah. And they were already telegraphing that they're probably not going to do away with the entire Affordable Care Act, even if that one provision is deemed unconstitutional.
That's
Is that
right.
what you're hearing in the news?
Exactly right. In the questioning so far, the justices have sort of signaled that they're likely to maintain rather than to strike it down.
So let's elaborate a little bit on the public health system, which, as you know, has been very challenged in the last 11 months. So where do you see spending going related to that?
Sure. Biden has made controlling the pandemic a top priority. And with the recent spike in infections, there's a lot of focus on that today. He's formed a COVID-19 advisory board to help guide the federal response. He is an advocate of mask wearing, social distancing, hand washing, as well as widespread and free testing and mobilization of the public health system to trace, test, and isolate contacts of positive cases. But importantly, following Pfizer's announcement this week of a vaccine that's 90% effective in trials in protecting people from COVID-19, there'll be enormous focus on the federal vaccine approval process and efforts to ensure that any approved vaccine is distributed equitably, efficiently, and free for every American. Biden has said that he's committed to building a modern public health infrastructure to support testing, treatments, and supplies, not only for this pandemic, but in anticipation of one in the future. He'd like to see pandemic management as a national function instead of one carried out in a somewhat disjointed manner across states. He's said he would launch a pandemic testing board and a personal protective equipment production program to ensure that there are plentiful supplies. He'd adhere to transparent criteria for vaccine approval and distribution, and finally expand the CDC's scientific team to trace outbreaks around the world, including in China.
So we're likely to see some action on that front very quickly.
Indeed, that's our expectation.
Now, Charlie, you mentioned about infrastructure in terms of the sector of the economy. Can you elaborate on that a little bit about what type of spending we can anticipate?
Sure. Biden has proposed a large-scale infrastructure package. His proposal is really wrapped up in his plan to combat climate change, spending $2 trillion over 4 years to escalate the use of clean energy with a goal of net zero emissions by 2050. We think expenditures would likely benefit electrical equipment and building products companies to a greater extent than traditional areas like machinery and construction. A Biden infrastructure package would boost spending in areas such as roads and bridges, public transportation, rail, water infrastructure, and 5G broadband. If we were to see a unified the blue wave scenario, we should expect more expansive Democratic proposals to include, some version of the quote Green New Deal that has a strong focus on efficiency and green infrastructure with plans for net zero carbon emission buildings. This plan would retrofit 4 million new buildings and 1.5 million homes with energy efficient technology. But it's worth noting that the GOP Senate has been pretty reluctant to go along with large infrastructure packages, due to a lack of attractive pay-fors. So as mentioned, expect an area of compromise and negotiation between a President-elect Biden and a Majority Leader McConnell.
Now, what about the environment? Although it's related to infrastructure and energy, reinstituting regulations that have been rolled back, building the EPA back up, rejoining international cards. What do you anticipate there?
Sure. As discussed, climate change and spending on the environment will be a major area of focus for a Biden administration. Looking at infrastructure, if Biden is willing to compromise with Republicans, analysts expect he could, look for modest incentives for green energy initiatives like solar, wind, electric vehicles. Biden has vowed to rejoin the Paris Climate Agreement on his first day in office. And this, of course, does not require Senate ratification. As president, Biden can circumvent Congress through executive orders that direct federal agencies to write rules and regulations. So he's expected to quickly sign a series of executive orders to reverse Trump policies and signal a change in priorities. For example, Biden campaign aides say that he will reverse President Trump's withdrawal from the World Health Organization. He'll repeal the travel ban involving some Muslim majority countries. He'll reinstate the Dreamer program. Many analysts also expect that Biden will seek to have the U.S. rejoin the agreement with Iran on its nuclear program.
Charlie, there's so much involved in our conversation. It's really hard to unpack in 45 minutes to an hour, but most of our audience are government contractors. So I want to be crystal clear for those who are listening to this, that over the next 4 years, we can perhaps anticipate more government spending to go into infrastructure projects, as you've mentioned, which means more opportunities for architects, engineers, and the construction industry, and all of the small industries and businesses that support AECOM Changes in healthcare policy, perhaps changes to the Affordable Care Act, will mean increased IT spending by CMS, which of course is in our region. There will also be, with more emphasis on green energy and public health infrastructure, that means more opportunities for scientists, engineers, medical device companies, laboratory equipment manufacturers. So I also anticipate, just based upon some of the things that you've been saying, that there's going to be more emphasis on innovation and leveraging small businesses. Historically, Democratic administrations have been more small business friendly, so we hope to see a return to more of that friendliness in terms of boosting small businesses with federal spending. At the same time, however, I don't see a reduction in defense spending, especially on cyber warfare, which also feeds our regional economy. So Charlie, our last topic here, we can't end without talking about COVID-19 and especially the surge that we're undergoing right now. So an additional over 1,000 people dying per day as of yesterday, an additional 116,000 infections per day. So it's really getting out of control. So what is the risk of another lockdown in the United States that may curb economic activity similar to what is taking place in Europe?
Sure. We are justifiably concerned that the U.S. is facing a nationwide outbreak of COVID-19. The severity of this third wave is greater than the prior two outbreaks, with daily new cases climbing to their highest level for the pandemic. It's important to note, as a caveat, more people are being tested now than in prior outbreaks. I think 1.4 million tests a day is what we're up to today. The initial upswing of COVID-19 cases in March occurred predominantly in the Northeast. This was followed by an outbreak in the Sunbelt states in late June and July. The current outbreak is being led by Midwestern states, which account for about 40% of daily new cases. Hospitalizations have reached a new high alongside new cases, and sadly, we are seeing fatalities starting to move higher to date. To date, the fatality to case ratio has risen less than in the spring and summer waves of COVID-19. The increase in US virus cases is occurring close on the heels of a major wave of cases in Europe, where worsening caseloads have prompted several countries to reimpose activity lockdowns of varying restrictiveness. The fear is that the US will track Europe and be forced to follow suit with lockdowns of its own, and eventually face the major hit to growth that now looms over Europe. So at this time, having seen what happened in the second quarter with a huge plunge in economic activity, followed by the V-shaped economic recovery that accompanied the reopening of the economy, we think that U.S. policymakers are going to be reluctant to push for European-style economic lockdowns going forward. We are cognizant, of course, that there are a number of announcements coming out lately. Governor Hogan tightening restrictions on restaurants and discouraging large gatherings. But we think that, like Maryland, other state governments are going to really focus their restrictions on higher risk activities. Whether that's gyms or indoor dining. And, from an economic perspective, the share of these activities in the economy is really not enough to slow economic growth in a material manner. So looking at the GDP impact of the ongoing outbreak, we think it's likely to remain subdued and relatively modest in the fourth quarter. Because consumer and business behavior, importantly, has adjusted to the post-pandemic environment. much, much better than in prior outbreaks, with many following the kinds of measures advised by public health experts. But that being said, COVID-19's lingering presence is going to keep a lid on growth in the coming months, and we're really not going to see a self-sustaining recovery of service sector activity until outbreaks are controlled. And frankly, that will involve having a medical solution approved. We're finally encouraged that the protocols for treatment of COVID-19 have become more effective over time. Further progress will be helpful, as well as the approval of therapeutics and eventually the approval of a vaccine. We expect that to happen with the Pfizer announcement last week and Moderna perhaps coming up soon. We expect emergency use authorization for the Pfizer vaccine really by the end of this year, and then a distribution in 2021 of the 1.2 billion doses that they're working on. But finally, the consumer is unlikely to have a sort of a normalized behavior until we do get out of this pandemic of fear that we've been living in, because that vaccine and the post-vaccine economy will be critical to restoration of confidence. As we like to say, tell me the course of the virus, I'll tell you the course of the economy.
And we're all looking forward to that, the post-COVID world. Well, Charlie, this wraps up our formal discussion. Let's take a few questions from our audience here. So the first question is, what will Biden's cabinet look like?
So yeah, this will be a Washington parlor game for the next few months. Looking ahead, it seems likely that he'll assemble a veteran team of Washington insiders to run key federal departments and agencies. Overall, we expect to see a mix of traditional liberals filling out most of the economic team and sort of more progressive nominees populating places like Health and Human Services and the Environmental Protection Agency. The issue for Biden will be getting some of his more controversial nominees through a nomination process that's led by Senate Republicans. Hardliners are most likely to get bottled up in committee and never get to the floor. On the other hand, liberal Democrats like Elizabeth Warren and Bernie Sanders might exercise some veto power if the nominees aren't being deemed to be sufficiently progressive. So it's going to be interesting. Finally, don't be surprised to see a Republican or two in Biden's cabinet, as he may want to signal a willingness to reach across the aisle.
Well, that would be refreshing if that happens. The next question is, what are the short-term impacts to the financial market if the president continues to challenge the election and does not concede?
Right. Yeah, it's the volatility that we saw coming up into the election was really centered around this potential of a contested election. Again, one of the things financial markets often look to are the betting odds, and the betting odds today show the likelihood of a Trump prevailing and attaining re-election to be less than 20%. Again, this is a dynamic figure, and it hinges upon people's assessment of his ability to prevail in his legal strategies, which seem, according to media reports and analysts, to be around maybe stalling the clock and trying to get the results that need to be certified in December, trying to get those impacted. So more to come on that, of course. The financial markets don't like volatility. They don't like uncertainty, excuse me, and they demonstrate that dislike through volatility. So expect some short-term choppiness until we see more clarity.
And the last question here is, with all of the focus on the Senate and the White House, what is happening in the House of Representatives?
Yeah, so Nancy Pelosi will really have one of the most difficult jobs in Washington. The Democrats lost many tight races in the 2020 election, and the Republicans are projected to gain about 10 House seats. That cuts the Democratic majority roughly in half. So that will mean that it'll be tough for Speaker Pelosi and her leadership team to govern the House. With a very narrow House majority, it seems that moderates are likely to become even more important. So, with the number of House seats needed to pass legislation being 218, you can expect that Democrats who represent some, suburban, more affluent districts that might be more Republican leaning in the past, they will have to be brought on board, or you're not going to get those 218 votes. But as I mentioned before, as when we look ahead to 2022, there has been a pattern of the incumbent party losing ground in the midterms. So in 2022, the GOP is within pretty easy striking distance of taking back the House. Historically, the party of the incumbent president loses ground, and since World War II, the president's party has lost an average of 26 seats in the House and 4 in the Senate. So even though it's really hard for us to think about another election, but the election of 2022 is really only 24 months away. And of course, here's to hoping that this time of at that time the pandemic will be a distant memory and our
Yes.
economy will be back in gear again.
Yes, here's hoping. Charlie, this has been phenomenal. You are a wealth of knowledge. It's almost too much to absorb, but we will be sending a handout that's going to be a summary of our discussion to the attendees. So thank you so much, Charlie, for sharing your wisdom with our audience today.
It's really been my pleasure.
And thank you all for attending. This is the last Scale Up presentation for the year, but we have an excellent program on tap for 2021, some very interesting topics and speakers. And I hope to see you then. Have a good day.
Right.